In the annals of financial history, 2024 stands out for a reason most wouldn't suspect. It was the year of the unexpected, the unpredictable, the downright bizarre. The financial world was caught off guard by a phenomenon that shook the very foundations of economic theory. This was not your typical market crash. No, this was something entirely different, something that turned the tables on conventional wisdom. This was the year of the reverse market crash, a financial event like no other. In order to understand the reverse market crash, we must first take a peek into the events that led to it. As we journey back to the years leading up to 2024, the global economy was much like a roller coaster. The highs were high, the lows were low, and the thrill was ever present. However, just like in a roller coaster ride, the anticipation of what's to come next was always looming. A series of economic conditions and policies played a significant role in this prelude to the crash. The world was in the throes of a trade war, with countries imposing tariffs and counter-tariffs on each other. As a result, markets were volatile, and the global economic growth rate was slowing down. At the same time, the world was also grappling with the aftermath of the Great Recession of the late 2010s. Central banks around the globe had maintained low interest rates for an extended period, hoping to stimulate economic growth. However, this policy had unintended consequences. It led to an increase in corporate debt as companies took advantage of the cheap loans. Meanwhile, major financial events were unfolding. There were high-profile corporate bankruptcies, and the tech sector, once seen as invincible, was starting to show signs of vulnerability. Financial experts started voicing their concerns. They pointed out the unsustainable debt levels, the overinflated asset prices, and the fact that the economic growth was not as robust as it seemed. However, these warnings largely fell on deaf ears. The general public, buoyed by the seemingly strong stock market, remained largely unsuspecting. In the midst of all this, a new financial instrument was gaining popularity: the reverse market. Initially, it was seen as a way to hedge against market volatility. However, as we would later learn, it was a ticking time bomb. Little did we know the market was setting itself up for a surprise. The day of the reverse market crash was a day the financial world will never forget. It started like any other day, with the ringing of the opening bell. Investors, analysts, and Wall Street professionals all ready to take on the day, none suspecting the financial whirlwind that was about to ensue. As the day progressed, something unusual started to happen. Stocks that were once considered the backbone of the financial industry began to plummet, while others, previously overlooked, began to surge. The market was turned on its head, and the world watched in disbelief. The reactions of the global markets were swift and diverse. European markets, already closed for the day, could only watch as the American market spiraled. Asian markets braced for impact, preparing for their opening bell. The global financial ecosystem was in a state of chaos. Investors and analysts were left scratching their heads. The patterns they'd come to rely on were no longer applicable. The market was behaving in a way that no one had predicted. Initial reactions were a blend of confusion, panic, and a desperate scramble to understand what was happening. The financial media was alight with speculation and theories. Analysts went back and forth trying to make sense of it all. Yet, amidst all the chaos and confusion, there was a grim realization setting in. This wasn't just a one-off anomaly. This was a seismic shift, a complete reversal of everything we knew about the market. By the time the closing bell rang, the landscape of the financial world had been irrevocably changed. The once mighty giants of the industry had been toppled and new players had taken their place. The day of the crash had ended, but its effects were far from over. The reverse market crash had arrived, and it was here to stay. The reverse market crash left a lasting mark on the financial landscape. This event, unprecedented in its nature, had far-reaching consequences that were felt in all corners of the globe. In the immediate aftermath, global economies were thrown off balance. Some nations found their footing relatively quickly, managing to recover within a few months. Others, however, were not as fortunate, grappling with the ripple effects of the crash for years. This was a stark reminder of the interconnectedness of our global economy, and how a single event can send shockwaves worldwide. Businesses too bore the brunt of the crash. Large multinational corporations saw their stock values take a nosedive, creating an economic environment that was rife with uncertainty. Small and medium enterprises, the backbone of many economies, were hit hard. Many were forced to shut down, unable to weather the financial storm. Individual investors, from seasoned professionals to everyday people investing their hard-earned money, were not immune to the crash's effects. Overnight, fortunes were lost, retirement plans were derailed, and dreams were shattered. The losses were quantifiable in the trillions, but the human cost was immeasurable. But not all was doom and gloom. The crash also presented opportunities. Investors who had been sitting on the sidelines found themselves in a buyer's market. Companies that had been undervalued or overlooked suddenly emerged as attractive investments. In the end, the crash served as a stark reminder of the cyclical nature of financial markets. It underscored the importance of diversification, sound financial planning, and the need for a long-term perspective when investing. The financial world had changed, and the lessons from the reverse market crash were hard to ignore. As we move forward, we must remember the past, learn from it, and use that knowledge to build a more resilient and inclusive financial future. From the ashes of the reverse market crash, valuable lessons were learned. This unprecedented event, which turned the financial world on its head, forced us to rethink and revise our strategies, policies, and predictions. In the wake of the crash, financial policies underwent a drastic transformation. Regulatory bodies worldwide began to implement stringent measures to ensure transparency and reduce speculative trading. The aim was clear: to create a more resilient and less volatile financial system. As a result, the landscape of the financial market today is vastly different from what it was before 2024. Investment strategies, too, evolved significantly. Investors, both individual and institutional, began to adopt a more conservative approach. The focus shifted from chasing short-term gains to securing long-term stability. This shift in mindset led to the proliferation of more diverse investment portfolios, with an emphasis on assets that could weather market volatility. Today, this is the standard approach for most investors, a testament to the lasting impact of the crash. Economic forecasting, once considered an arcane art, became a science in its own right. The crash exposed the flaws in traditional forecasting models, prompting economists and analysts to develop more sophisticated tools. These new models incorporate a wider range of factors, from geopolitical events to climate change, providing a more holistic picture of the market's potential trajectory. In essence, the reverse market crash of 2024 forced us to confront the realities of an ever-changing, unpredictable financial landscape. It taught us the importance of adaptability, resilience, and foresight in navigating the world of finance. The lessons learned from the crash are still relevant today, shaping our financial decisions and strategies. They serve as a reminder that while markets may fluctuate, our commitment to learning and evolving should remain constant. The reverse market crash of 2024 was a wake-up call, a reminder of the unpredictable nature of financial markets. The reverse market crash of 2024 was a turning point in financial history. It was an event that took many by surprise, yet it was a wake-up call for others. It demonstrated that the market, like a pendulum, has a rhythm of its own, swinging between highs and lows. And it's our job to understand this rhythm, to anticipate it, to dance with it, rather than be caught off guard. We've journeyed through the unexpected phenomenon, the prelude to the crash, the chaotic day of the crash itself, and the aftermath that it left in its wake. We've gleaned lessons from this unique market event, lessons that should shape our approach to investment and wealth creation. The importance of diversification, the value of a long-term perspective, the need for diligent research and staying informed, these were not just lessons from the reverse market crash of 2024. They are timeless principles that should guide every investor's journey. But remember, every market event, every crash or boom, is a chapter in the grand narrative of finance. And as we turn each page, we gain a deeper understanding of the market's dynamics, of its ebbs and flows. We learn not just to survive, but to thrive in the world of finance. And that, dear viewers, was the story of the reverse market crash of 2024. For more insights into building wealth and understanding financial markets, do subscribe to our channel. Remember, knowledge is power in the world of finance.